Hello everyone. This video is going to cover the Selling and Administrative Expenses Budget. So parts G, H, and I of our demo problem 14.1. So if we look at G, we've got budgeted monthly selling and administrative expenses of, we have these fixed expenses. So fixed expenses means those do not change, okay? If we look, we've got salary expense. So we've got someone on salary or people on salaries. We've got utility expenses that stay the same, depreciation, rent, and miscellaneous expenses that just won't change from month to month. To find this depreciation, it's $750 a month. They tell us that we purchased $100,000 of equipment on January 1st. We've got a 30-day trial period, but we pay for the equipment on the 31st, and the equipment is expected to have a 10-year useful life and a $10,000 salvage value. So to find our depreciation, we need to use that straight line depreciation expense and take our 100,000 minus our salvage value, which then we find that should be 90,000. And then we divide that by our useful life, which is 10 years, to get that this is going to depreciate $9,000 every year. But now we're starting at the beginning of the year, so it's going to depreciate for 12 months every year, which then gives us that depreciation expense of $750. So that's just a refresher on how we find that. So now we're going to prepare our selling and administrative expense budget. So we come down here and we see that we have our January expenses are all filled in for us. So that salary expense, again, remember we have the salary expense, our utilities, depreciation, rent, and miscellaneous. Those are all of those fixed expenses. So they're not going to change over these months. So we might as well just fill those all in. So for February, $24,000 worth of salary expense, $14,000 worth of utilities, $750 in depreciation, $3,600 in rent, $900 in miscellaneous. And those are the exact same for March. Oops, not 14,000, 1,400. All right. So now what we've got to figure out is the sales commission and our supplies expense. So we have to look and say, we see that our commissions are 5% of our total sales. Well, that means we have to go back to our sales budget. So we see that we budgeted in January 400,000. So if you take 400,000 times 5%, you find that it's going to be that $20,000 that we budgeted in January. So the other numbers that we need are this 440 and the 484. So let's go sorry about that. Let's go back down here. So again, for this January, we took 400,000 times 0.05 and we got that 20,000. So then for February, we need to take the 440,000 times 0.05. Actually, let's do that up above so we have some room. I think I made these better for you, but for February, we're going to take 440,000 times 0.05, and we find that should be 22,000. And then for March, it would be 484,000 times 5%, and that equals 24,200. So that would be our commission because you're making 5% on all of the sales. So now we've got to figure out our supplies expense. Where's that going to come from? Well, if we look back up here, looks like supplies are coming from our purchases, right? So we've got to look and say, okay, how are we figuring this out? Oh, wait, never mind. It tells us our supplies are, sorry about that, supplies expense, 2% of your sales. So take those same numbers times a different percent. So this first one would be 400,000 times 2%. So take the same thing, 400,000 instead of times 5, take that times 0.02 times 0.02. And when you take 440,000 times 0.02, you're going to find that it would be 8,800. And 484,000 times 2% is then 96,080. When we add all of those up, for February, we end up with total selling and administrative expenses before interest of $61,450. And for March, we end up with $64,530. So those are our projected selling and administrative expenses. When we actually fill out the schedule of cash payments, again, that salary expense is not going to change. We have to pay that. The supplies expense we can just take from what we found up above, the 2% of sales. So in February, it is going to be that 8,800. And in March, it's going to be that 9680, what we just found. Our rent is not going to change, and our miscellaneous is not going to change. So now we have to figure out our commission and our utilities that we're paying. So what they tell us is that we pay 100% of our commissions the next month. So in the first month in January, we don't pay anything in sales because that's or in sales commissions, because that is our first month that we are in operation. So if we look, in the month of January, we had sales commissions of $20,000. We don't pay that in January, we're going to pay that in February. So that $20,000 goes into February. Even though it was earned in January, we pay it in February. Same with utilities. Even though we earn our utilities in January, we're not paying them until February. So that $1,400 of January's would be paid here. And then the same is true for March. The sales commission that we earned in March or in February is now going to be paid in March. Oops, not 22.4, just 22. And the same is true for our utilities. Even though our utilities are the same, we still pay them. So we've now paid off the $20,000 and the $22,000 in commission, and we've paid these 2 months for utilities. Then we have to add all of those up, and when we do that, we find that our total payments in the month of February are going to be $58,700. And in the month of March, when we add all of those up, we're going to get $61,580. So that is part G and H, because we prepared that schedule of cash payments. So now for I, we need to use the information developed to determine the amount of sales commissions payable, utilities payable, and accumulated depreciation on March 31st for the pro forma balance sheet, and the amount of selling and administrative expenses on the first quarter pro forma income statement. So if we look at this, we want to find our sales commission. So what's left at the end of March? Well, if we've paid off the $20,000 and the $22,000, all that's left for our pro forma statement is this commission from March. So the $24,200. So that's going to come straight over because that's what we have in sales commission payable. Same is true in utilities. We're looking for utilities payable. We've paid off the $1,400 from January. We've paid off the $1,400 from February. So all we have left is this $1,400 from March on our books. What's the amount of accumulated depreciation? Well, we add these together and find out that we should have total depreciation of our equipment of $2,250 when you take the 750 times 3, or 750 plus 750 plus 750. And then the last thing we want to know is the amount of selling administrative expense for the first quarter before interest on our income statement. So we have to add up these bottom three. What were our total selling and administrative expenses in January, February, and March when we add them all up, whether we paid them that month or not? Not talking about cash flow at this point. We're just talking about what expenses did we incur in January, February, and March. And when we add all of those up, we end up with $184,630. And that is how you create your selling and administrative expense budget and the schedule of cash payments for your selling and administrative expenses.